November does not seem to be a good month for American consumers, as we are seeing household debt jumping the most since 2008. Now, this by itself would be kind of a bad indicator, just seeing household debt skyrocketing, but it's even worse when you consider the fact that credit card rates and interest rates in general are surging right now. Add on top of that the fact that many people are facing furloughs, their hours cut at work, many people are starting to get laid off now, especially in tech jobs, but more on that in tomorrow's video. Real quick word from today's sponsor, iTrust Capital. iTrust Capital allows you to use your retirement account to invest in Bitcoin, gold, and silver. Many people, when they buy gold or silver or Bitcoin for the first time, they just go out and they make the purchase, whether it's from a gold dealer or buying Bitcoin from an exchange. Later on, whether it's a year or 2 years down the road when the price has gone up a lot, they go to sell it and realize they're hit with a capital gains tax. This leaves people with a sour taste in their mouth when investing in gold and silver and Bitcoin because they're saying, hey, look, I know that inflation is eating away at my fiat currency, my dollars, but if I put my money in sound money, if I buy gold, if I buy silver, if I buy Bitcoin, I'm going to get hit with a tax on it anyway. And that's why it's so important to take advantage of retirement accounts when you are diversifying your assets. The problem is most brokerages, most retirement accounts do not allow you to invest in gold or silver or Bitcoin or any other cryptocurrencies. That is where iTrust Capital comes in. You can buy and sell Bitcoin, gold, silver inside of your IRA anytime. You can use this retirement account to make new contributions, or you can even use old retirement account money rolled over into an IRA with iTrust Capital. With everything going on right now in the crypto industry, many people are concerned about any exchange, any place that allows you to buy cryptocurrencies, about security and fraud. With iTrust Capital, they never take custody of your assets. There is no mingling of assets, and there is no way for iTrust Capital to access clients' money. It is securely stored in third-party institutional storage that is cold storage. And it's a regulated trust company so that it is a legal IRA. Like I said, they take security very seriously, which is why I use and recommend iTrust Capital to invest in gold, silver, and Bitcoin for your retirement account. And if you use my link in the description below, there's a special bonus waiting for you as well. Suffice it to say that right now is not a good time for anybody who is forced to go into debt. However, many Americans are finding themselves in that situation right now. This is a classic boom-bust cycle that is unfolding before our eyes. Number one, you have artificially easy credit, low rates. The central bank lowers rates and makes money extremely easy to access. Not to mention printing a few $1 trillion. Step two, that money gets spent by the government and it starts working its way through asset prices. So immediately you have a wealth effect and everybody feels extremely rich as the price of assets like homes and stocks go through the roof. Third, everybody starts spending a lot of extra money because they think they're rich. And so people start spending money like crazy, and especially when the FOMO sets in and people realize everybody's trying to buy the same things, but the money didn't create more things. And so now there's more money chasing the same amount of goods and services. So there's shortages everywhere. So if I don't go buy it right now, I might miss out and not be able to get it. Very quickly, this drives up the prices of goods and services and eventually gets to the point where production catches up with all of that increased demand. Because heck, if everybody's buying way more stuff, might as well start producing more stuff to take advantage of all the demand. But lo and behold, you get inflation, and then the central bank gets worried about their currency losing too much purchasing power, so they pull back and shut off the easy money spigot, driving rates up and stopping the money printer. Well, as soon as there's no more new money coming into the economy, where are you going to get the money to afford to keep on buying all the stuff that you've always had to buy? Number one, you're going to sell assets. So the asset prices now start to drop, and what was a boom starts to show up as a bust in asset prices. And then when you can't sell assets anymore, because most people, most Americans, more than 50%, don't have any assets to sell in the first place. So once you run out of that, you just have to start spending all your savings. Now prices are higher, you have no savings, you have no assets. What do? You go into debt. And that's exactly what we're seeing right now and why US household debt has jumped the most since 2008. 2008, despite the fact that rates are higher. Households added a staggering $351 billion in debt last quarter. The total is now at $16.5 trillion. Now, most of that increase came from mortgage debt, which makes sense given the fact that house prices went up a lot because of all the additional buying, and even though interest rates have skyrocketed, house prices still have not come back down. And just as a side note, in case you're wondering why prices have not yet come back down for real estate, all the people who bought a home within the last couple of years are locked into 2.5% to 3.5% on their mortgages. That means if they sell their home and buy an equivalent home, they can't afford it because the rates are now 7%. If you can't afford to buy a new home, which barely anybody can now, if you can't afford to buy a new home, that means you can't afford to sell your current home. So ironically, the high interest rates right now are preventing people from selling, which is preventing a wave of selling from driving prices down. If we look by category here, we can see that there was a big change in mortgage debt, up $282 billion. And the second largest category here, unfortunately, is credit card debt, adding $38 billion. But it looks like millennials have gotten suddenly financially responsible as student debt has dropped by $15 billion. I wonder how that happened. Now, this credit card increase is really devastating for most Americans because the average rate has climbed above 19%. This is why I always say that fixed rate debt, if you use fixed rate debt to buy an asset, that's a fantastic way to be able to short the dollar. You've borrowed something and then exchanged it for an asset. Same thing as if you borrow shares and then exchange them for dollars, you've shorted those shares, and then you have to exchange dollars for shares again to be able to give those borrowed shares back. That's how you close out the trade. When you borrow dollars to buy an asset like a rental property, you have actually shorted the dollar. So in this environment, fixed rate debt is actually an asset. That is the asset. It's not the house. It's just a mechanism by which you can short a currency that is failing faster than the interest rate you're paying. But an adjustable rate debt is very different here. Credit cards are always going to be way higher than the inflation rate because they're not collateralized by anything, and so lenders will always charge a really high interest rate because they can. Credit card balances have reached a record high here. This is not a chart that you want to see moving up and to the right. And of course, the Fed hits the nail on the head here when they say the real test will be to see whether borrowers can continue to make payments on their credit cards. And if I was a betting man, I would say that there's a good likelihood that we will start to see a drastic increase in delinquencies and defaults on credit cards pretty soon here. I've said it before and I'll say it again. Right now is probably one of the most dangerous times in our lifetime to be heavily in debt, especially like credit card debt, adjustable rate debt. This is because if inflation continues to chug along, those rates will only continue to go up. It could get to the point very soon where a lot of people cannot make their minimum payments. So buckle down, budget down, make sure you are the master of your money and that your money's not master of you. Get out of that dangerous debt as fast as possible. And hopefully you'll be able to do it in enough time to be able to take advantage of these assets at some of the lowest prices that they'll be in a very long time. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.